Hi everyone. Today we will be reviewing pharmacy financial model. So this video will be useful for those entrepreneurs who want to start this type of business. I will be showing what inputs affect financial efficiency of the pharmacy business, what parameters affects the payback period, the financial efficiency parameter, what inputs affect the cash flow statement. So if these overviews are valuable for you, please like, share and subscribe to our YouTube channel. So first of all, we need to create a rule that will ease future scenario building, stress testing with our financial model. So we need to highlight all the inputs through all the model. So, and we are creating the rule saying that all inputs are colored with this specific blue color. So these are the inputs, these are the inputs, these are the inputs. This will ease this future scenario building for you, for third parties, investors, your business partners, whoever will be using this model. So you need to ease the process of finding the inputs, building scenarios, stress tests and so on. So this will help you a lot if you highlight the inputs. So we are starting with specifying the first year of financial projections. So this will be the first year when investment stage begins. Then we're moving to the next and one of the most important blocks of inputs. So in our pharmacy, we need to create different type of customers. We can name each customer one by one, and here we're starting with an ability to switch on and off each customer from our model, from calculations. So what it gives us? It gives us the following. So once we are done with the model, so we've created some scenario. We're looking at the cash flow and we see the simple and discounted payback period, and we think that we are too optimistic with this or that type of customer. So this column gives us an ability to switch off this specific type of customer and see how this specific type of customer affects our business idea. Maybe we're too optimistic and we need to rethink the business concept. This will help you a lot during the stress testing period, scenario building and so on. So you will be playing a lot with the switch on and off buttons. So this is crucial for when model will be ready, many steps ahead forward. So you will be playing with this a lot. Then we're moving to the average check for each type of customer. So here we're specifying the average check for each type of customer, and then we have a special column for the coefficient. So we can specify the value of the average check for each type of customer, and here we can increase this average check. So this will be the final value of the check, and this is the coefficient that we'll be using together with this. So this column will be useful again when you will be building the stress tests and different scenarios. So you will be increasing these check and see how, let's say, decrease or percentage increase or decrease of this check will affect the simple and discounted payback period, the financial efficiency, the net present value and so on, without playing with the numbers itself. This will show you how stable your business idea. Then we're specifying the percentage of direct costs inside the average check. So this is the next column that deals with direct expenses. And the same story, we have the percentage coefficient column for the direct cost. So we are adding coefficients columns for for every input, because this will give us an opportunity to have more flexibility during scenario play, stress testing environment, many steps ahead when financial model will be ready. So going forward, so now we need to start describing different types of customers that we have from different perspectives. And the first parameter that we will be looking at is how often each type of customer visits our pharmacy. So here we have the types of customers, and in this column we specify how often this type of customer visits our pharmacy per month: 1 time, 2 time, 5 time, 10 times, and so on. We also have coefficient for that. This will be the final value for the amount of visits for this type of customer per month. Going forward, next parameter that will describe our types of customers will be how many customers of these types visits our pharmacy these times per month with this average check and so on. So we're specifying that for customer type number 1 we have 6 customers per month. So these 6 customers, each of these customers visit 1 time per month. They are paying us $20 check, and the direct cost will be $4 inside their check. So we are describing customer type by customer type. The more accurate will be this description, so we will be able later to switch on and off this specific type of customer and see how this revenue and direct costs and the cash flow from this customer affects the cash flow, payback period, and financial efficiency numbers. Then we need to understand that our business, our pharmacy business, may have or may not have the seasonality. So here we have this means we need to create some block of inputs for the seasonality. So we have 10 types of customers, and 100% means that we are staying at these basic levels. And if we, for example, assume that the revenue will go down in summer months, we're just starting to decrease the percentage value, making the revenue go down in summer months and start increasing towards the winter months. So we can create here any seasonality. This seasonality will also affect the cash flow statement, and this is very important because your business, lots of businesses also always have some seasonality. Plus, we need to mention that some types of customers may have seasonality, other types of customers may not have seasonality, and all types of customers may have different types of seasonality. So we need to add seasonality anyway to our model and see how seasonality affects the cash flow, because if we have some decrease in summer months, for example, this may lead to operating losses inside the cash flow statement. Let's say, for example, in this particular case we don't have losses in summer, but if it does, if the business has this level of seasonality, we may face some operating losses in summer months, and then increase, and we need to let's say finance these operating losses from the cash flow generated inside the previous months. So this is crucial, and you will be able to see that, and if you start modeling that, you will show for yourself, for your investors, for business partners, that you understand that your business has this seasonality. And those people who want to invest in your business idea will understand that you understand this business. So this is very important, not only for you, but for all third parties who understand that you understand that seasonality affects your businesses. So they understand that you know the business that you are that you ask them to invest. So this is very important. And when you have some business idea in mind, always start thinking of what type of seasonality affects your revenues, your costs, your types of customers, and so on. So this is very important, interesting, and crucial for the accuracy of your financial model. Then we need to specify when we start the operating activity, when we get the first revenues. We specify the year and month when we get the first revenues. Then we need to understand, so the next block of inputs is showing us that we won't be able to get the maximum of revenues, maximum of targeted revenues right from the first month of operating activity. So if you can see here, May 2021, we are saying that we are targeting to get only 10% of targeted revenues. And once you are done with the model, once you finished with all your assumptions, you will be playing a lot with these percentage values, because these percentage values significantly affect the amount of financing that you need to start your pharmacy or any other type of business. Because the reality, you must understand that you won't be able to get the 100% of revenues right from the first month of operating activity. You will be gaining these revenues, target revenues, month by month, step by step. And these percentages will create the operating losses. Let me show you these losses inside the cash flow statement. So this is the cash flow statement. And as you can see here, we have a couple of months, we have 4 months with operating losses. And you need to add these losses to these investment plan expenses, will be finally forming the total financing that you need to start the business. And once your model is ready, you will start playing with these percentages, and you will be able to see how much additional financing you need to add to your budget if your business will be reaching break-even point faster or with a lower speed. And you will be able to see, for example, in scenario A, you will need $1 million if the business reaches target revenues faster, and you will need, let's say, $1.5 million if the business reaches its break-even point, let's say during the first 8 or 12 months of first 12 months of operating activity. And you will be playing with percentages a lot, looking at these losses and looking at the total amount of financing that you will need in this or that scenario. So these numbers, these percentage numbers, will tell you a lot about the financing that you need to start your business. So pay attention to that. This is very important. So this is one of the mostly used parameters when future business owners are playing with the model. So they're playing because this shows us the significant difference between financing needed in this case, that case, in optimistic and pessimistic basic case, and so on. So this will give you a huge portion of a new information. Maybe some business owners, they start rethinking their business concept. So you will get a lot of new information looking and playing with these numbers. Then we're moving forward. We start playing with the payroll. So here we have the names of positions. Then we specify the monthly salary of one person on each position. And then we are moving to the headcount for all the positions. So here is the first month of operating activity, and here we specify the growth of the headcount on each position from the first month of operating activity and further. And then we extrapolate the headcount starting as of 13 months, a month of operating activity. Then we are moving to the fixed costs. So first of all, we name them one by one. You need to know what types of fixed costs you have in your pharmacy. And what is interesting about fixed costs, so despite of them being so called, they may also have some seasonality inside the typical year. So for example, some fixed costs will be paid once every month. Some of them will be paid once in a quarter, once in half a year, or once in a year, like insurance and so on. Some of them may have some specific algorithm, some payments inside, let's say January, April, May, September, November, and you have to create some block of inputs where you will have a typical year on the top header, and you will be allocating these fixed costs inside these typical year. This will also increase the accuracy. Maybe there are some spikes in these fixed cost payments. You may have some operating losses because of that. So that's why you need to create a separate block of inputs for the fixed costs and create the typical year where you will be allocating these fixed cost payments. Then we're moving to the investment plan. So here we have the first month of operating activity, and then we are going back and we're assuming that we have 3 months of investment stage. So here we specify what we're going to invest in, and here we're specifying how much we're going to invest in this or that investment plan item. Then we are moving to the loan if we have one. So we're specifying the year and month when we get this loan, the amount of this loan, interest rate, term of loan in months, and if we have some grace period for the principal payments or interest payments, we can specify it here. Then we briefly describe the taxes. So we may have some revenue tax, profit tax, payroll tax, asset tax, and so on. So we can specify it here. And then we're moving to one of the most important parts of the financial model, the cash flow statement. And so what cash flow statement is showing us? So first of all, cash flow statement is showing us how much equity do we need in this particular scenario. So if we have 200,000 loan, so this means we additionally need this amount of equity to finance our business idea. If we start playing with seasonality or any other parameter of inputs, we will see how these numbers change. If we look at the last line of the cash flow statement, cash balance at the end of the period, we will be able to see that first of all our project is eating the cash. Let's see it here. Then here we have mathematical zero when all the cash has been eaten, and then we can see how the project starts generating its own cash flow. And we can see, for example, so if we totally need $300,000 for this specific scenario, we can look going forward to the cash balance at the end of the period. We will be able to see that somewhere here in April 2022 the project has generated the same amount of money that was invested in this particular scenario. So looking at the cash flow statement, we're able to see how much financing is needed, what type of financing is needed, when this financing is needed, and when this financing is going to be back. If we go further, we can see a simple table consisting of equity that we need, loan that we get, total financing needed. Then we have simple payback period diagram. Then we have the table with all the financial efficiency that we get in this particular scenario. Then we have the discounted payback period diagram. Then we have a very simple table showing us the revenues, expenses, profit per month, profitability per month. Then we calculate simple and discounted payback period. We're able to see when negative turns positive. This is the moment when this is showing us when the project has generated the same amount of money that was invested in it. This is the moment for the simple payback period. This is the moment for the discounted payback period. Then we have simple and discounted payback period diagrams on the same chart. Then we are specifying the discount rate for the project. This cell showing us here we can specify the step with which we are changing the discount rate when we're calculating the internal rate of return. So now we're moving to sensitivity analysis block. So this block you will be using a lot when your financial model is ready and you would like to see how stable this or that scenario is. So here you can specify the parameter that affects the input that you will be looking at. So this cell affects this line, and you can play with this. And what you can do, you can add this parameter. Let's say you can delete this data. This is the result of the sensitivity analysis for the previous parameters. So what you can do, you can go to the top, you can go to the, let's say, customer number 10. You can add this sensitivity analysis parameter to this input, so you can multiply the inputs to this sensitivity analysis parameter. Press enter. So now this sensitivity analysis parameter has been added to the model. So what you can do now, you can press sensitivity analysis button and see how increase or decrease of the frequency of visits for this customer type number 10 inside the pharmacy will affect the financial efficiency of your business idea. So let's go back and press the sense button. So as you can see, you can add this parameter to any input and you will be able to see how this or that parameter affects the financial efficiency of your business idea in this or that scenario. So I hope you enjoyed this pharmacy financial model overview. If you find these reviews valuable, we have a couple of hundreds financial models to review. Please like, share and subscribe to our YouTube channel. Thanks for watching, see you next tutorials, and bye.